Hope you can hear me because I can't see your response. Okay, which means you can hear me. Thank you. Now, today we are continuing with the same discussion that we had last week and moving to a new area as well as time permits. We talked about the interest rates last week, and I think I looked at certain definitions of interest rates like simple interest rate, the compound rate, the nominal rates, real rates. All these are different definitions or variants of the interest rates. And then I looked at why there are different interest rates in the economy. Why cannot we have a simple or single interest rates in the economy? Interest rate in the economy. We know there are various types of interest rates and at different levels. And we looked at why, the reasons. We look at some, theoretical explanations on that. We realize that interest rate differ uh, from each and every interest rate differ from one from the other because of the risk factor and the maturity factor. Risk is simply the possibility of default, and we have seen various types of interest rates are driven by different risk levels. Similarly, different maturity levels, which means how long the financial instrument will be held by the people, will also be a factor in deciding the different types of interest rate, different levels of interest rate. So we discuss them under risk structure of interest rates and term structure of interest rates, and also we looked at under term structure the concept of yield curve. Yield curve is a kind of a plot between the rate and the maturity, and that is a reflection of where the interest rate structure is heading in the economy. We have seen in a typical yield curve, short-term rates are low and long-term interest rates are higher. Short-term interest rates means roughly in the periods of 3 to 1 year, we consider them as short-term rates. Long-term, actually, we may call it as 10 plus years. They are long-run rates, and also you can call in between as the medium-term rates. So the rate structure is different or dependent on this time period, and you will see an upward sloping curve. It's a typical or normal curve, upward sloping, because people expect in the long term rates would be higher. The main factor behind this is people expect inflation rate to be higher in the future because of the economic activity. People think in the long run economic activities will happen, and as a result there will be demand in the economy, and we know demand is driving inflation, so people think inflation will be higher in the future. And from the Fisher effect we have seen inflation and the real rate is determining the interest rate. So based on the Fisher effect, we can think in the long run, people think inflation should be higher, the rate should be higher. So that is one thing that we have seen from the yield curve. The other thing we have seen from the yield curve is we can see some of these rates are parallelly moving up and down. Now, for example, in this chart, the June rate is given, rates are given by the thick black line. And if you look at the red line or the blue line, the upper blue line, which is basically June 2008, it is above this black line. So that indicates during that period, during June 2008, interest rates were higher. And if you look at this green line in March 2009, that is lower compared to the black line. So interest rates were lower. So parallel ups and downs, which means the interest rate increases and decreases, indicate the movements of interest rate structure in the economy. So when interest rates are increasing in the economy, the entire yield curve will shift upwards. When interest rates are going down, entire yield curve will go downward. So this is an indication of the movements of interest rates. And then I started the discussion on interest rates in Sri Lanka. And I remember I told you there are various interest rates in the economy, and I requested you to look at the various interest rates that we have in the economy in central bank publications, annual report or recent economic developments, whatever. I asked you to look at these interest rates and their definitions. So today we have already covered actually these policy rates under monetary policy discussion. So you can easily have the rates and definitions for them. But at the same time, I ask you to look at some of the market rates in the following slide. So probably let's check whether you have some idea, knowledge on these. Even if you haven't gone through this annual report or whatever, so still I think you can contribute to this discussion based on your knowledge. Okay, policy rates. I'm sorry. What do you mean by policy interest rates? I think I made it very clear. Policy rates are like the central bank decided interest rates. The main or the benchmark rates in the economy starts with the central bank action. So when central bank is changing its monetary policy, central bank is either increasing policy rates or decreasing policy rates. So when you look at, when you see an increase in the interest rates, you can call it a monetary tightening. When you see a decrease in the interest rates, you can call it a monetary relaxing, or monetary policy is basically easing. So those are the directions based on the interest rates that we can observe. So what are these policy rates used by the central bank? Right now in Sri Lanka, we actually have three main policy rates that we can identify. So one is SDFR, the other one is SLFR, and the bank rate. Okay, now what do you mean by SDFR? Can someone basically suggest a definition for the SDFR, standing deposit facility rate? SDFR means standing deposit facility rate. How do you define it? Can anyone suggest a kind of a definition for SDFR? Any idea? Standing deposit facility rate. What is that? Any response? Can you hear me? Okay, I see some answers here. Rate paid by commercial banks when depositing in central bank, someone says. Excess money that commercial banks deposit at the central bank. Minimum rate of absorption of overnight excess liquidity from the banking sector by the CBSL, Amanza. Yes. When CBSL sells securities for the commercial banks. I think many of you have some idea I think most of the ideas are accurate. Uh, what do you mean by SDFR, Standing Deposit Facility Rate? As someone said, when central banks have excess liquidity, they come to the auctions of the central bank. On daily basis, there are auctions. Sometimes there may not be auctions depending on the central bank decision. But let's say there is excess money in the economy and central bank is conducting auctions. So when central bank is conducting auctions to absorb money, commercial banks can come and access that auction to deposit their money. So that is the normal practice. Sometimes some commercial banks, they cannot succeed at the auction, which means they cannot secure a certain place at the auction. So they will be kind of failing from the auction. But what can they do with their excess money? So their excess money, they have to do something. Otherwise, they are basically incurring a loss on that day because in their accounts, they have excess money. So as a result, they can come to the standing deposit facility to deposit their excess money. So you can call it, as I think many of you have suggested, this is the rate, standing deposit facility rate is the interest rate paid by the central bank when commercial banks deposit their excess money with the central bank. Someone wanted to repeat it. I think repeating the definition. Standing deposit facility rate is the interest rate paid by the central bank when commercial bank wants to deposit their excess money with the central bank. This rate is actually the overnight rate. Overnight means you deposit today and you will take it back on the following day. So on the overnight basis, the central bank is paying an interest on this deposit. Okay, you got the point? Clear? Want me to repeat? I think most of you have given similar answers. Now, Sadhana, I don't know Sadhana or Sadhana, says when CBSL sells securities for commercial banks. I think that answer is correct. Basically, what happens there, when commercial banks are depositing money with the central bank, they get a security for them. Basically, government securities. That is the normal practice. But right now in Sri Lanka, you have to keep that in mind. When central bank absorbs this excess money, right now the central bank does not give any security for commercial banks, which means commercial banks are now depositing money only, excess money, but they don't get any securities. That is under standing deposit facility rate. That is actually under the standing deposit facility, SDF. That is happening actually at the end of the day, 3:30, around 3:30, when commercial banks see they have enough for excess money. What they will do is they will come to the SDF and deposit at SDFR rate, and no securities will be received by the commercial banks. Clear? But if they come to the auction, in the auction actually that happens with securities. If they come to the auction and they deposit money, they will receive treasury bill or bonds from the central bank as securities. But if it is under SDF, at the end of the day, when they depositing excess money, they only depositing money, no securities involved. The reason is the central bank is a trustworthy institution and there is no risk that the central bank will default. So as a result, you don't need to have securities. So here actually not only commercial banks in Sri Lanka, we have both commercial banks plus primary dealers. We both call them as market participants. Market participants. Okay. Clear? What is the current rate of SDFR? If a commercial bank or a primary dealer wants
4.5%.
4.5%. We call them as the lower bound of the interest rate corridor. Okay. The other rate, standing deposit facility rate. Sorry, standing lending facility rate, SLFR. How do you define it? Definition. Isuri, I need the definition. How do you define it?
When the commercial banks borrow from the central bank, the interest which the commercial bank has to pay to the central bank.
Exactly. So as I said, when commercial banks need money in the morning, they can come to the auction. Central bank conducts when the market is not having money, enough money, central bank can conduct an auction to give money to the market. So there you come to the auction. You call them as a reverse repo auction actually. So in a reverse repo auction, commercial banks can borrow. But again, that is only a limited amount. All commercial banks will not be successful. So at the end of the day, they will see, okay, they need some money. For example, they want to pay an investor, they want to pay a depositor, they want to settle some bills. So they need money. So in the afternoon, they will realize they have to have some money. So there's no way to, there are different ways that they can borrow money. For example, they can go to the cold money market, repo market, or whatever, they can borrow. But the most cheapest place to borrow and most convenient way to borrow is from the central bank. So they come and borrow from the standing lending facility. So when they borrow, they have to pay an interest. So someone clearly said, I'm not so sure who mentioned that answer. Someone gave the answer very rightly. When market participants, both commercial banks and primary dealers, when they need funds to fulfill their liquidity needs on overnight basis, they can borrow from the central bank by paying an interest. That interest we call it as the SLFR, standing lending facility rate. Now earlier I told you when they deposit, there are no securities involved. But when they borrow, they have to place securities, which means they have to deposit securities and borrow. So that's why I call it, it's a kind of a reverse repo facility, which means you give money, you get securities, central bank. On the following day, central bank gives away securities, they will receive money with interest. So it's a kind of a reverse repo transaction. securities involved. I hope it's clear. Commercial banks and primary dealers can borrow from the central bank for their liquidity needs at a particular interest rate. That interest rate is the standing lending facility rate. Currently, what is the rate?
5.5.
5.5. So someone said 6.5. Actually, now it's 5.5. There's 100 basis point difference between the standing deposit facility rate and the standing lending facility rate. So as a result, let me go back to the slide. So in this slide, if you look at this chart, this blue shaded area is the policy rate corridor. So the lower bound is 4.5, that is SDFR. The upper bound is the 5.5, which we call as SLFR. So this corridor between the two rates, you call it standing rate corridor, or sometimes you call it PRC, policy rate corridor, formed by the policy interest rates. I hope it's clear. So these are the main rates used by the central bank in change in the monetary policy. So when the central bank changes monetary policy, either it can change one of these rates or both rates can be changed by the central bank. Clear? Any questions? If you have any questions, you have to speak, please, because I can't see the chat box when I put up the slide. So if you have any question, please unmute yourself and talk. Okay. Even the answers I prefer if you can, say it verbally rather than typing, because I can't see the chat box from here. Third one, bank rate. What is the bank rate? Now, the bank rate is the oldest policy rate in Sri Lanka. These two rates, first two rates actually, which we talk about, I think from 2002. So they are like relatively new. But from the beginning of the central bank, we had this bank rate. For some time, we have actually not used it too much, or not popular that much. But now again, recently the central bank reduced this bank rate. What is this rate? Is anyone having any answer? Probably you are typing, but does someone want to, say something on this?
A bank interest rate which a national central bank lend to money to domestic banks, often in very short-term loans.
Okay. In which conditions? What sort of conditions? You're right, you have some point there, but when does the central bank provide this funding to commercial banks? Now, commercial banks, they are not only commercial banks, financial institutions. When they operate, they face some problems on day-to-day operations. Sometimes they face problems that can be covered from the standing lending facility. If they need money on daily basis, they can cover it up from the standing lending facility. But there are some situations they don't have funds for a while. And also there are some situations the bank is facing some stress. Maybe customers are withdrawing money, maybe they want to pay their debtors, they have some liquidity issues. Maybe sometimes during some certain periods, the entire financial system is in a stress, so the bank would need some support. So in such cases, we consider them as relatively long-term issues. Long-term in the sense not for years, but not overnight problem. You need to have some support. When you need to have some support, when a bank is in a problem, usually they are unable to borrow from the markets. So in the coal market, no one will lend if you believe that bank has a problem. Repo market, people will not lend because they know this bank has a problem. So they are, kind of a skeptical to give some funds. So in such case, people or the banks, they don't have people, not people, right? Don't take people. Banks, they don't have any option. They only have one option, which we call as the last resort. Signaling කියනවා බැරිම තැන කියලා, right? So බැරිම තැන as the last resort, they come to the central bank. So central bank gives them loans based on securities for a certain period in order to revive their liquidity positions and relieve the stress. So as a result, you can define, I'm just giving you the definition now, bank rate can be defined as the rate at which the central bank provides funding to financial institutions when they have imminent financial issues or threats. When market participants or the banks have an imminent financial stress or issues, they borrow from the central bank at the bank rate. Now, for some time, the bank rate was fixed. For many years, it was 15%. Now, actually, the bank rate has been reduced by the central bank. Last year, it was reduced by the central bank. And the central bank determined that the bank rate will be dependent on the standing lending facility rate. So as I remember, standing lending facility rate plus, if I'm not mistaken, 300 basis points is the bank rate. So which means if the SLFR is 5.5, bank rate is 8.5. So that is allowed to change now. That rate you can see it's a relatively high rate. Why it is a high rate? It is a kind of a penalty rate for the commercial banks. When they have some issues, they can come and borrow from the central bank at that rate. Why it is kept in high levels? To discourage commercial banks to access the central bank for funding. Otherwise, if it is a lower rate, they will come always to the central bank asking money. That is a problem because it will give a negative signal to the market about that particular bank. It is kept purposely high. So which we call as the bank rate. Sometimes we call it as the lender of last resort rate, because we have seen commercial banks come to the central bank as the last resort to borrow. So at that time, commercial banks should pay this rate when they want to borrow. Okay. Fourth one, actually it is referred to as the operating target. What do you mean by operating target? This is the rate used by the central bank when conducting its monetary policy. So when the central bank wants to conduct monetary policy, the central bank, we already know, use these policy rates. They can use SRR given by this line, or they can use OMOs, open market operations, using these standing deposit facility and standing lending facility rate. Now, these rates, central bank cannot, influence every time. Every night you can't change policy rates. So that's why you call it policy rates. The policies change time to time, not always. But on a daily basis, that decision taken by the central bank in terms of changing monetary policy has to be implemented. So when the central bank is implementing that interest rate decision, they need to have an operating target. So the operating target is the mechanism for the central bank to implement or activate its monetary policy. So how this operating target is affected? Through the open market operations of the central bank. So when the central bank sees surplus money, central bank conducts OMOs to absorb money. When the market is having deficit money in the system, central bank is injecting money. Why this absorption and injection would be used by the central bank in terms of operating target? Because the central bank needs to keep the stability of interest rate. Interest rate stability is important. So there is an important aspect of the central bank policy to keep the interest rate stability. So what is the indicator to look at this operating target? How can the central bank, implement its monetary policy through an operating target? For that matter, central bank is using this AWCMR. So AWCMR means, I have given the full word here, average weighted cold money rate, which we call as the operating target of monetary policy. Can someone define this operating target? What do you mean by AWCMR?
The average call rate weighted by the value of the transactions.
Okay, correct. What do you mean by call transactions? Where do you see these call transactions? What do you mean by call transactions? I think what you mentioned is right, correct answer. I'm just curious whether you have some idea about the call transactions. What do you mean by that? Does anyone having any idea? what is the coal market? How do you define it? Coal market means what sort of transactions we have?
Where trading does not take place continuously but only at specified times during the trading day, transferred at specific time intervals, and
I didn't hear it properly, but I heard you were saying some, trading date and banks operating, things like that. Maybe you got the point correctly. In the coal money market, actually, that is the market where commercial banks, right? You have to be very clear. In the coal market, only commercial banks operating. So the coal market is the market where commercial banks fulfill their funding needs on short-term basis, mainly overnight basis. So we call it overnight coal money market rate. The idea of coal means in this market, you don't have any securities. Commercial banks borrow or lend in the coal market based on without any security, based only on the trust. Let's say I am commercial bank A, I need some money. I just call commercial bank B and ask some money and they will lend me at a particular interest rate. Let's say I am having surplus money, excess money on that day. I know if I go to the central bank, I can deposit at a lower rate. But I'm trying to give it at a higher rate in the market, and I look at other people who wants money and I give them loans at a particular interest rate. So the call means actually by telephone call. You call and you go obtain money from the market. And as I said, it's only mostly overnight and you settle on the following day. There are some long term as well, in the sense 7 days, 1 month, likewise, but mostly overnight. So this is a very active, dynamic market where commercial banks borrow and lend each other. So the average weighted coal money rate means, as someone said, the average weighted, the idea weighted means these rates are calculated by given certain weights. Particular interest rates have particular weights. How these weights are given? Based on the size of the loan. So based on the sizes of the particular loans, you give some weight and taking the weighted average of these, you calculate a rate called weighted average coal money rate or average weighted coal money rate. So as a simple definition, you can say the average weighted coal money rate is the rate at which banks, it's an average rate that reflects the bank's borrowing and lending in the short term overnight coal money market. The average weighted coal money rate is reflecting the average rate of borrowings and lending of the overnight coal money market, where banks fulfill their short-term funding needs. Banks fulfill their short-term funding needs. Okay. Any question on that? let me check your transactions that occur among banks in the case of liquidity issues. These are generally very short term. Yes, someone has said, given some answer on the call rate. It's among banks. It's only the commercial banks. If primary dealers, they need money, similar money, from where they can get? We know from the central bank, they can get at a particular rate. But if they want to borrow from the market, how can they do? Primary dealers, they borrow or lend in the repo market. There is another market segment, short-term market segment called repo market. Yes. Can you repeat the definition of AWCMR? Yes, sure. So AWCMR is the rate that reflects the borrowings and lending. You can call average. I'll repeat again. The AWCMR is the average rate that reflects borrowings and lendings of commercial banks in the call money market, where commercial banks fulfill their short-term or overnight funding needs. Explain the standing rate corridor and get the definition. Standing rate corridor means, as I said, the interest rate gap between the standing deposit facility rate and the standing lending facility rate. Standing deposit facility rate means the rate that the market participants deposit money with the central bank. Standing lending facility rate means the rate that the market participants borrow from the central bank. So the lower bound is standing deposit facility rate, upper bound is the standing lending facility rate. The gap is basically 100 basis points or 1%. That 1% is actually the corridor. Usually the call money rate moves within this corridor. If you look at this chart, you will see the call rate is given by this red line. So you will see most of the time the call rate is within the corridor. Last year only you will see it is actually at the very lower bound of the corridor. Why? Last year we know, even now the market needs support in terms of low interest. So in order to provide low interest rates, the central bank has kept this call rate as much as low to support the interest rates in the economy, lower interest rates in the economy. So the good thing is central bank can manipulate this red line, which means central bank can manipulate this AWCMR through the corridor. It can allow even it goes above the corridor, below the corridor through open market operations. We know through the open market operations, central bank injects money or absorbs money. So by injecting, the central bank can keep this rate low. By absorbing money, the central bank can push up these interest rates. So OMOs are very closely linked with the average weighted call money rate where the central bank is trying to maintain some kind of a stable behavior in this rate. So now if you look at during last 3-4 years, we see this call rate is very stable. But there are some periods, for example, in 2001, this call rate went up really high. Even you can't draw here. For example, it went up to 100% sometimes in 2001 in a crisis period. But mostly during last many years, we have seen it is within the central bank corridor. Okay, let's move on. The other type of interest rate is the treasury bill rates. Treasury bill rates, we consider them as short-term interest rates, where the rates applicable for 3 months, 6 months, and 1 year treasury bills. Now in the left-hand side chart, you will see 3 months means 91 days, 6 months means 182 days, 364 day means 1 year. Now these interest rates are actually a kind of a plot of these different tenors, 364, 180, 91 day. So you will see the movements of these rates. In some cases, you will see some blank spots, which means during those periods, the central bank has not conducted auctions or auctions were not successful. There is an auction, you have an interest rate here. So this is actually reflecting the short-term market behavior. Now we know treasury bill rates are actually very low levels because other rates are also low. Now in this chart you will see the call rate is very low. Similarly, right now the treasury bill rates are also very low. So these are short-term rates. Treasury bond rates are long-term government securities rates, but unfortunately for treasury bonds, we cannot draw a chart like this because there is no continuous issuance of a particular security. Let's say 5-year security. You don't have the 5-year bond auctions every week. Those are irregular. So as a result, you can't draw a smooth line. But that is also part of the interest rate structure in the economy. Now, by plugging both treasury bill and treasury bond rates, you can draw a yield curve for Sri Lanka. Now, these are yield curves where you have the interest rate and the maturity on the other side. So, if you plot interest rate and against the maturity, you will see these curves. So, as I said earlier, this yield curve in Sri Lanka, it's a normal curve right now. Why? Short-term rates are low, long-term rates are high. So, upward sloping. Second thing you can see based on the yield curve, how interest rates are moving. Now, the green line that indicates high interest rates. Purple line that indicates low interest rate. Now, if you look at purple line is for 2019, September. We know during last year, the interest rates were very low. If you draw 2021, you will see this line has further come down. So, which means the interest rates are further low. So, yield curve is a construction of government security interest rates. So, it's a reflection of government security interest rates against their maturity, whether it's short term or long term. That will give you some idea. Okay. Then the market rates. Now, if I draw a simple, line of transmission, we start with policy rates. The policy rate is reflected in government securities rates. From government securities, you will see the impact on the market. So market means there are various markets, banks, non-banks, stock markets, insurance, etc., etc. But mainly what we look at here is market means from the bank's point of view. So these are called as commercial bank lending and deposit rates. If you look at this chart, there are various lines. Some are overlapping, some are moving in the same direction, and you will see interest rates have over time gone up, gone down. Likewise, you can make various definitions. So in this definition, you have these same abbreviations that I have used. And I asked you to look at the definitions based on the central bank annual report. So probably you may have some idea about these. Can we basically discuss? So let's start with the AWPR. Let's come back to the chat. Then you will be able to give some answer. What do you mean by average weighted prime lending rate? The first one, AWPR. So here we are looking at the definitions of each interest rate. Can someone suggest a definition for the AWPR? First one, AWPR. The extended version is average weighted prime lending rate, AWPR. In some books, in some countries, you call it AWPLR, average weighted prime lending rate. Does anyone want to define it? AWPR, lending rates offered to the prime customers in commercial banks. Yes. Amanza, your answer is perfectly. Sadhanika, yes, AWPR is calculated by CBSL weekly on base lending rate offered to their prime customers during the week. Both answers are correct. Okay, now I'm asking you a question. What do you mean by prime customers? Who are these prime customers? They are the most credit-worthy customers. Or you can call them as the top category of customers of a bank. So word prime means they are, good. They are trustworthy. They are the best from a bank's viewpoint. So on that notice, on that account, AWPR, as you have rightly typed here, is the average of the weighted average, right? Every time when I say average, that is weighted average. Weighted average rate of loans, weighted average interest rates on loans offered to the prime customers of commercial banks. Say it again, average weighted prime rate is the weighted average interest rates on loans offered to the prime customers by the commercial banks. So each and every bank has, some prime category. So they are giving best rates to these prime borrowers. So if you take a weighted average of all these prime borrowers, that is actually the average weighted prime lending rate. Okay. And as Sadanika said, this is calculated by the central bank on a weekly basis. So it's a weekly rate. Every Friday you have this rate. Right now, I think that rate has come down to around 5 point something. I think 5.5. So you will see the prime customers can borrow at a rate around 5.5 from commercial banks because they are main customers. Okay, clear? Any question on that prime rate? No. Central bank is publishing a monthly rate also for this prime rate. For example, you take the 4 weeks together and average it, you get a monthly rate. And this is important because banks are using this rate as a benchmark rate. For the banking sector, their contracts are mostly linked to this prime rate. For example, if you are signing a contract with someone, you can connect it to the prime rate. You can say, okay, if I want to pay, when I pay this, I will pay at prime rate. Or someone say, okay, I will pay a prime rate plus 1%, 2%, likewise. So it's an important interest rate in the banking system. Next rate is the AWLR. Now, one thing I want to say in this prime rate, actually, they are short-term loans. These prime borrowers, they are actually short-term loans. They are not for a very longer period, 30 years, 40 years, but mostly short-term loans. That is also, you can keep that in mind, but when defining, you may simply say that is the average rate offered for the prime customers. Next one, AWLR. The extended version is average weighted lending rate. Average weighted lending rate. What do you mean by that? Does anyone having any answer?
Interest rates of all outstanding loans and advances extended by commercial banks to the private sector.
That is the average rate of loans offered by commercial banks to the private sector. Okay, that is a reasonable definition. I see another answer calculated by the central bank monthly based on interest rates on all outstanding loans. That is an important point. This rate is reflecting the average of all lending rates offered to the customers by the commercial banks of all outstanding loans. What do you mean by outstanding loans? That is the stock of loans. If a particular commercial bank has, loan portfolio for last 10 years, based on the 10-year interest rates, the central bank can calculate a weighted average interest rate. So that reflects all the interest rates on every loan. So in the loan portfolio, the commercial bank might have, personal loans, housing loans, credit card loans, any other property loan, educational loans, everything. Low interest rates, high interest rates, medium interest rates, everything would be there. So that is reflecting the all the interest rates offered to their customers. So you can say average weighted lending rate, as someone has clearly said, average weighted lending rate is the interest rates of commercial banks, weighted average interest rate on commercial banks, all outstanding loans. Okay. We may not specify private sector there. I think someone said private sector. The reason is even the government loans could be there. We don't know. In the total loan portfolio, there could be some, government loans also. But when we calculate it, we, basically exclude any government related loans are there. We are trying to exclude. In defining, we better say very safe. That is basically the average weighted interest rate on all outstanding loans offered by commercial banks. Okay. Any question? Okay. What is the next rate? AWLR. AWLR. What do you mean by that? Average weighted new lending rate. Average weighted new lending rate. Can someone define it? What do you mean by average weighted new lending rate? Okay. Amansa says weighted average interest rates of commercial banks of all new loans and advances. That is the perfect answer. Weighted average interest rate of commercial banks on all new loans and advances. Now, this Chanika, she said the AWLR is basically based on all outstanding loans, which means whatever the loans you have in your portfolio for last many years, it's there. As I said, that may capture high interest rates, low interest rates, everything. But whatever the recent rates are not captured in that AWLR, outstanding loan rate. You need to know, similar to prime rate, what is the rate based on the current scenario for loans. So for that matter, central bank is calculating the weighted average interest rate for new loans based on the loans given in a particular month. Let's say you take last month loans and their interest rates to calculate AWLR. So that is weighted average interest rate of commercial bank loans, of all loans and advances, but they are new loans and advances, right? So I'll repeat the definition. Weighted average interest rate of commercial banks on all new loans and advances, you might add within a particular month. Within a particular month. Because that captures only that month, not the historical loans. Okay. Next one, AWDR. Up to now, what we have discussed, AWPR, LR, NLR, all are lending rates. Now we are moving to deposit rates. AWDR, what do you mean by that? Average weighted deposit rate. How do you define it? Average weighted deposit rate. How do you define it? So could you please repeat the definition for AWNLR? Sure. That is the weighted average interest rate of commercial bank all new loans within a particular month. Okay. Are you okay, Kiran? Okay. Right. We were talking about AWDR. How do you define it? Average weighted deposit rate. Does anyone want to give any answer? Okay, Sandanika says AWDR is calculated by the central bank monthly basis on the weighted average rates of all interest bearing deposits of commercial banks. Right. I think you are exactly taking the central bank definition, which is very good, which states that you have basically read the central bank annual report very clearly. Correct answer. So AWDR, or average weighted deposit rate, is the weighted average deposit rate for all outstanding interest bearing deposits of the commercial bank. It is the weighted average interest rate for all outstanding interest bearing deposits of commercial banks. Outstanding means all the deposits are there. Usually age of a deposit is a 5-year maximum. So this indicates all the deposits given, rates offered to the deposits for last 5 years. And it is only for interest bearing deposits. Why? When you are taking all the deposits, you don't take, current accounts because they don't have any interest. So here, obviously, what you have is deposit rates for all savings, time, and call deposits. When you say all interest bearing deposits means savings, time, and call deposits. So your answer is correct. It is the weighted average interest rate for all interest bearing deposits of commercial banks. Next one, AWFDR. What is that?
Weighted average rate parenting to all outstanding time deposit held with commercial banks.
Exactly. Correct answer. That is the weighted average interest rate for all time and not actually time and all time deposits of commercial bank. Sometimes you call it fixed deposit, isn't it? Fixed. That is the rate reflecting all outstanding time or fixed deposits of the commercial banks. Because if you take AWDR, there you have both time and savings. Times deposits are relatively long-term deposits. Savings deposits relatively short-term for day-to-day purposes. Their rates are relatively low. What happens when you have both together in AWDR, you cannot actually see what is the real response of interest rates based on the current interest rate structure. So for that matter, you have to exclude the savings component and calculate what is the rate for time deposits only. So by calculating AWFTR, we can get some idea about the weighted average interest rate pertaining to all outstanding fixed deposits or time deposits of the commercial banks. Finally, AW, I think what I have put here is AWNDR. Yes, AWNDR. What do you mean by that?
Interest rate pertaining to all new interest-bearing deposit placed with commercial bank during a month.
Exactly. As Isuri clearly mentioned, that is the rate offered on all interest-bearing deposits within a particular month, which means all new deposits within a month. I'll repeat it. That is the weighted average interest rate on all new interest-bearing deposits of a commercial bank. So all these AWLR, NLR, DR, FDR, NDR, they are monthly rates, which means you calculate based on monthly data. Only AWPR is a weekly rate where you calculate that on a weekly basis. Clear? Before I go to the chart, does anyone having any idea? Define it again. Yes. NDR. Okay. Weighted average new deposit rate means the interest rate, weighted average interest rate pertaining to all new interest-bearing deposits of commercial banks. The important word there is new interest-bearing deposits, not outstanding. Okay. On that basis, you can even calculate AWNFDR. Central Bank is doing that. Actually, I was involved in these calculating these or introducing these rates at the central bank sometimes back. So there we calculated a fixed rate also for a particular month. You can simply exclude the deposit rates and calculate only for fixed deposits. So you can define it most of the ways. Right now I am aware central bank is calculating weighted average SME rate. What is the rate applicable for small and medium term medium-sized enterprises. So likewise, you can define most of these things. Okay, can I move to the chart then? If you don't have any more questions. Okay, if I move to the chart. Right. Now, if you look at this chart, you will see all these movements. Now, generally what you can see right now, interest rates are coming down because we know most of the rates are low at the moment. Now, if you look at the particular rates in this chart, you will see the red line is the average weighted deposit rate, AWDR. As I said, there you have all outstanding deposits. So that is the lowest rate because it includes all savings and time deposits for historical rates also. And if you look at this chart, in general, the highest line is the black line, which is AW. This is AWDR. Black line is AWLR. We know that is the outstanding loan rate for all the loans, outstanding loans. Now it is actually, in the most cases, that is the highest. If you take the difference between these two, you call it interest spread. In banking language, you call it NIM. NIM means net interest margin. So this indicates the bank's profit. How much they charge on loans on average, how much they pay on deposits on average. Roughly, if you look at over time, it's very constant, right? So roughly 6% is maintained by banks as their profitability. Based on this is only one indicator that is called as NIM. Now you will see the middle line here. That is actually AWFDR, and you will see how it's moving over time. So as I said, that is relatively higher than the DR because you exclude the savings deposits, and you will see on average how it has been moving over time. Even the new rates, you will see how it moves when you remove the legacy impact, which means the outstanding category. If you remove it, how the new loans are moving, you can get some idea. Now, especially if you look at this period, you will see actually the loan rates are coming down. Why you can say that? If you look at the new lending rate, it is actually lower than the average weighted lending rate, which means all new loans are given at lower rates. So by looking at these charts, you can get some idea about the interest rate structure in the economy. And there are some other rates published by the central bank, some administratively determined rates are there. We call them as legal rate and the market rate. Now, when you look at the numbers, you will see both legal rate and the market rate, they are similar. Legal rate and the market rate, they are similar, but they are defined in two different legislations. Legal rate is defined under Civil Procedure Code. Market rate is defined under Debt Recovery Act, which means these are some legal provisions in terms of interest rates. What are these legal provisions? In the case of a default, when you want to recover some money, based on these two acts, you can file a case in a court. So in the contract, if there is no agreed rate of interest mentioned, which means in the contract you don't have particular rate mentioned, whether it is a prime rate or AWLR, whatever, it's not clear. So in that case, the court will decide the recovery or the compensation will be based on the legal rate or the market rate. So that is actually decided by the law enforcement authority in terms of these acts. So central bank every year, at the end of the year, they calculate this rate based on deposit rates in the, sorry. Can you hear my voice? I think I did some mistake when I was clicking the slide. Can you hear me?
Yes, sir.
Okay. Sorry. So I hope you can see the slide as well, right? Can you see the slide, please?
No, sir.
No. Let me check. Now?
Can, sir.
Great. Okay. So the legal rate and market rate, as I said, they are for specific court cases. For recovery of money or for compensation, when there is no agreed rate it is mentioned, this rate is applied. This is published by the central bank every year at the end of the year in the government gazette. So we have published this rate in the gazette for each and every year. So that rate is changing over time. If you look at the numbers, you will see the rate is changing because that is based on the available or current interest rates, because this legal rate and the market rate is calculated based on the commercial bank deposit rates. So that's why you see it's moving. But this rate, once it is published, that is applicable for whole year. For example, what is published at the beginning of 2020 is applicable for whole year. It's a kind of a flat rate. Right. Now, there are some other interest rates. Those are actually what I have discussed. Local interest rates or domestic interest rates. There are some interest rates which are used in international markets. So these rates are very important because the global transactions or in international financial markets, we see these rates are available. Now, for example, the very first rate is we are discussing is the federal funds rate, Fed funds rate. Fed funds rate. Fed funds rate is basically, Fed is the central bank of United States. So this is the main central bank in the world. The first central bank in the world. First in the sense, the key central bank in the world. So their rate is influential for all global interest rates. So Fed funds rate, actually I have given you the definition, interest rate at which depository institutions lend reserve balances. Reserve balances, you can simply say cash, okay, to other depository institutions overnight on uncollateralized basis. Now, when I was telling or discussing about the call money rate in Sri Lanka, I told you commercial banks are lending each other without any collateral. So you call it weighted average call money rate. That is based on trust. So here the Fed funds rate is a similar rate where the depository institutions in US, banks and some other category, you call it depository institutions. They are lending to each other without any collateral, without any security. So that is a kind of a base rate which you call as Fed funds rate, Fed funds rate. Now there is another rate called Fed funds target rate. That rate actually decided by the central bank. Fed funds target rate is decided by the central bank. Now here I have given you a chart. It's a target rate. So when we say the Federal Reserve is raising or decreasing interest rate, that is actually the target rate. Now right now, if you look at the target rate is in the range of 0 to 0.25 because of this corona pandemic period. During global financial crisis also, they lowered the target rate around that level, 0 to 0.25. So in recessionary periods, they are basically reducing this rate, which is the target interest rate of the Federal Reserve. Fed funds rate is actually the actual rate that is determined in the market through their actual transaction. So the target rate actually moving very close to this. Sorry, not the target rate, the Fed funds rate, because it is actually the market rate. So it's an important benchmark in financial markets. As I said, if the Federal Reserve monetary policy is basically changing, which means if the central bank reduces interest rates or increases interest rates in the federal market, that will have an impact on the whole world and also on various interest products. So this is an important interest rate in the global financial market. The other important rate is the LIBOR, London Interbank Offered Rate. Now this rate is an indicative rate. Indicative means the central bank, the banks in the London financial markets, a panel of a bank, they are indicating their willingness to lend at this rate. That's why you call it offered rate. Offered means they are giving some indication, okay, we would like to offer you a loan at this rate. So it's a panel of banks. A number of banks are there in that, specified list. So based on that, you can calculate interest rate to understand the behavior of interest rates on that particular date or a period. Now in Sri Lanka also we had a rate called SLIBOR. We don't use it too much now. SLIBOR, which means Sri Lanka Interbank Offered Rate. This is also an indication of banks to lend money at particular rates. So it came from the original idea of LIBOR, London Interbank Offered Rate, which is the indicative target average rate in the London financial market. Now these are calculated for 7 different maturities and 5 different currencies. If you look at this table, there are various maturities, overnight, 1 week, 1 month, likewise up to 12 months. And there are various currencies, for example, dollar, US dollar, sterling, European euro, Japanese yen. For each and every currency, you can calculate a LIBOR rate. But mostly, when we say LIBOR, that is USD LIBOR we talk about. This is the main interest rate. So this is an important benchmark rate in the world market because most of the financial contracts are based upon this LIBOR rate. Even as Sri Lanka, when we want to borrow in international markets, our rates are based on the LIBOR. It will say, okay, LIBOR plus 2%, LIBOR plus 3%, likewise. So when you say LIBOR plus, that indicates it's the benchmark in the financial market. Now, if you look at the movement of LIBOR, as I said, during this corona period, interest rates have come down. Even the LIBOR rate is very closer to 1% or 0 to 1% actually. It's very low. During the global financial crisis also, these rates came to very low levels, right? Right now, they are at very low levels because to support the financial market, it has come down actually through the natural forces in the markets. Why interest rates are important? It is related to price stability and monetary policy objective. I remember someone asked a question, what is the relevance between CCPI and NCPI for monetary policy? I saw someone raise a question. So CCPI or NCPI in Sri Lanka, what does that suggest? The movement of inflation. So in this chart, if you look at, inflation is given by this dotted line, right? So that is measured by the CCPI or NCPI change, inflation rate. Now this inflation rate is related to monetary policy. Why? As I said, when inflation is going up, central bank is raising interest rates. In this chart, you will see the standing deposit facility rate and standing lending facility rate during the peak times of inflation, it has gone up. See, here, here, here. It has been increased. When inflation is going down, you will see it has been reduced. For example, during this period, inflation is low. Standing lending and facility rates have been reduced. So when you increase interest rate, you call it tight monetary policy. When you reduce interest rates, you call it relaxed monetary policy. So you will see when inflation is going up, interest rates are increased, the monetary policy is tightened. In this chart, you will see some red periods, red color shaded areas. All these shaded areas indicate monetary policy has been tightened. Green areas suggest inflation has gone down, interest rates have gone down, which means monetary relaxation period. So all these green areas, monetary relaxed periods. So monetary policy and interest rates, they are linked through the interest rates. Okay. Someone making some noises. Can you mute yourself, please? Okay. Is it clear? Someone asked that question. Let me check. I remember someone was having this question. I can find it, but okay. Isuri, you raised that question. CCPI and CPI. So CCPI and NCPI is related to inflation. Inflation is related to monetary policy. When monetary policy is tightened, interest rates are going up. When it is relaxed, interest rates are going down. Clear? I think we have only 1 or 2 slides, then we'll finish. Now, why these interest rates are important? Because they are affecting the financial markets. In the financial market, the changes in interest rate will have impact on the market prices. For example, when interest rate goes up, there is a clear link between the rates and the prices. So price, the interest rate. There is a negative relationship. I'm not going to technically explain this, but simply you can, keep that in mind. When interest rates are low, the prices are high. When interest rates are high, the prices are low. This can be understood through bonds, right? So we will do some treasury bill bond discussion in the future. There you will see there is a negative relationship between the price and the interest rate. So that happens, and if the prices are changing, there is an impact on the financial market, on the stock markets, on the bond markets. Different market segments will be affected due to interest rate. Especially, interest rates have an impact on the depository institutions, especially the banks. Why? The banks' profitability is linked to interest rates. We have seen net interest margin. So their difference between the lending rate and the deposit rate is their profitability. So if the rates are changing, you will see the profitability is changing. Their investments are affected. Investments means the assets. So as I said, the interest rate and the price of an asset has a negative relationship. So if interest rates are changing, that will affect their investments and assets. The cost will change. When interest rate goes up, the bank cost would change. When interest goes down, the bank cost would change. So all these have impacts on banks, balance sheets, and P&L. So that's why we have to pay some special attention to interest rates in the economy, not only because of monetary policy, but because of other aspects that is created by the interest rates in the economy. So I think we are done with the interest rate discussion. If you look at the past paper questions, you will see what I have discussed is basically captured in the questions. I told you bank rate, Fed funds rate, repo rate, LIBOR rate, we all discussed. I indicated what is LIBOR, and I told you right now LIBOR is not used that much in Sri Lanka. That is the bank's indicative rate. Indicative rate for lending. Sri Lanka interbank offered rate. Now related to this interest rate, some of the questions are actually, as I said, numbers. For example, what is the stand-in deposit facility rate? What is the real rate? Right? I think we discussed this thing. If inflation rate is 2% and real rate is 3%, what is the nominal rate? Simply 5%. I hope you remember the Fisher equation. We discussed these things. Main thing I want to highlight is there are some questions, not the numbers or definitions, some scenarios. For example, if you look at this thing, central bank policy rates to commercial banks. Why these policy rates are important for the commercial banks, right? Now, this case, what is the applicable interest rate when commercial banks borrow from the central bank? I think I very clearly told you that is SLFR. So you have to pay some attention to questions like this, some of the conceptual things, and not the conceptual things, some of the practical things. Why this rate is important? If there is a change in interest, what will happen to this investment? Likewise, there are some questions related to your thinking ability and practicality. So you have to pay some attention to these questions. Probably we will find some time in our workshop. I plan to have a workshop towards the end of the program. Let's see how we can proceed. Now I think last week we had last year's exams. 2 cycles were completed together. which were due actually for some time. We were able to conduct exams physically. So let's see whether we will be able to, meet very soon in the class. That date is very uncertain, but we are hopeful that we can, meet in the class very soon, rather than having these online classes, for a extended period. If we can meet actually, we can have a very nice workshop by discussing all these questions and all that. We'll see what will happen. Right, okay, with that, I think I'm done for the day. I have already shared you the next week's discussion, that is actually central bank, on central banking. So next week we are starting to discuss the financial institutions, starting with the central bank. So please read through the slides which I have already shared, and it's very straightforward and simple things, and when you read it you will understand what I'm talking about. And if you come to the class with some preparation, with some discussion knowledge, that will be helpful for us to have an effective discussion. Okay, so let's stop at this point, and I'll meet you next week at the same time with the next discussion. Okay, if you don't have any questions, we can wind up. You are free to ask any question. We have some time as well. If not, we can conclude. Right? So let's meet next week. Have a good weekend and good week ahead. Thank you. Good night.